Stay tuned for the second half. I'll be talking to Ian Williams about silver. Hi, I'm Max Keiser. Welcome back to the Keiser Report. Time now to turn to Ian Williams, who is Chairman and CEO of Charteris Treasury Portfolio Managers. Ian, welcome to the Keiser Report.
Okay, thank you.
Okay, Ian Williams, you recently made headlines with a very bold prediction for silver. You say that silver will rise fivefold in the next 3 years. Tell us about it.
Well, it's based on a combination of technical and fundamental factors, cyclical factors as well. And one of the interesting points, looking at the cycles in silver, there's an almost perfect 10-year decennial pattern in silver. And then every year since silver was floated, since gold was floated in 1970, every year, with a year ending in 2, has marked the major bottom in silver. Every single bear run has ended in a year ending in 2. And we're now in 2012.
Okay, now viewers watching some of them will listen to this, and it sounds a bit arcane to them, this idea that there's technical patterns that years ending in 2, etc., would drive the price. However, the biggest money in the world, the hedge funds out there and money managers out there, of course, they incorporate technical analysis in what they do, their decisions, and what they allocate resources. So it doesn't matter if the average person out there kind of buys into the technical analysis or not. The fact that the major money is, and they've got a lot of money to spend, it becomes almost, I wouldn't say self-fulfilling prophecy, but it definitely informs their buying decisions. And if you bring in these big buyers, what is the current composition of the largest portfolios in the world today, allocation toward gold and silver? Because the last I checked, it was very, very low.
It was very low, about 1%.
1%?
Yeah, probably about that, yeah.
Of investable assets around the world are in precious metals?
Well, precious metals stroke gold and silver mining stocks, yeah.
Now, any bump in that number at all would seem, you take the silver market, which is only 1 billion ounces above ground, that's a, what, a $32, $33 billion market. We're talking about portfolios that are $500 billion in size. Correct. If they just go from 1% to 2%,
that's correct.
Tell us what happens.
Well, you get a rather sharp upward movement in the price, which is historically, see, if you're in a precious, if you look at fundamentals for a second, we think the biggest fundamental driving all these bull markets in precious metals is money printing by the central banks, led by Ben Bernanke at the Bank of England. Looks like the Japanese central bank are going to be at it soon, Chinese central bank. So all the major central banks in the world are all effectively got their foot rammed down hard on the money printing machine. Now, if you're an investor in precious metals, any precious metal, this is the best backdrop you can have. And if that's the case, if we're in a bull market for precious metals, it's 99% probable that silver will outperform gold. Silver will go up more in gold. It's higher beta. It's from a lower base. Every time you get a bull market in precious metals, you would expect silver to go up a much greater percentage than you do gold. So if you believe the precious metal story, you should buy silver rather than gold. And if you don't believe it, you shouldn't buy either.
Okay, I want to talk about silver versus gold in a second, but sticking on the central bank theme, over the past 5 years, since the beginning of this big crisis, the central banks around the world have increased the supply of their bonds or money by hundreds of percentage points. In the U.S., for example, they've gone from roughly 15 to 45 trillion increase in paper that they're floating from the government. During that period of time, the supply of gold is up maybe 8%.
That's correct.
So here you have gold up 8% supply, not the price, but the supply, and the supply of paper is hitting up multi-hundreds of trillions of dollars. And so, once again, we covered in the first half of the show, I'll get your take on this, Henry Kravers of Colbert, Kravers and Roberts. They are now packaging their private equity into a public offering, giving the public a chance now, finally, to take a piece of KKR after years and years of being a private equity firm. Isn't this kind of like ringing the bell that the bond market's is over, the rally's over, and we're heading for a crash?
Well, I think almost certainly you are heading for a crash in the bond market. I think sort of US Treasuries and UK gilts are the most overvalued assets on earth. And we also run a gilt fund, so it's not as if we have any great vested interest in pumping gilts. I mean, yields on 5 and 10 year Treasuries and 5 and 10 year gilts are now below where they were in the Great Depression. Well, you know, things may be bad out there, but they're not that bad.
Okay, let's get back to gold and silver. So there's traditionally a ratio between the two.
Yes.
right now it's, I believe, 52 to 1, silver to gold on a price basis. That's very extended and not the norm. Talk about that.
Well, it depends how far you want to go back to try and guess what the norm is. If we're correct in what we're saying, is in that in a bull market, silver will go up a lot more than gold, then that ratio is obviously going to move a lot more in favour of silver.
Well, that drives part of this rally in silver is that the compression of that ratio. So it goes back to the more historical 16 to 1 or so.
Well, also, I mean, if you think about other things as well, China, for example, has just introduced a new futures exchange in silver, which with a much lower denomination contract. So there's lots of people in China who can afford to buy silver and silver coins, but they can't afford to buy gold coins. It's often referred to as a poor man's gold. So it's mass market. I mean, if you're an investor and if you're getting virtually nothing on deposit, you're getting nothing in the bond market, and you're worried that all this money printing is going to cause inflation at some stage, gold and silver are the best things to turn to. But there's a lot more, the audience that can buy silver is much, much greater than can buy gold.
Let me get your thought on this also, is that if we're heading toward this collapse in the bond market and gold and silver once again becoming strategic and probably being monetized by at least one country, possibly China, the fact that Britain only has 300 tons of gold, how badly does that position them for this future realignment?
Well, I'm not sure it will be monetized in the way that it used to be monetized. The Basel Agreement for banks' capital ratios is going to allow gold is going to move up from having a 50% risk weighting to 100% risk weighting. So it's probably going to be private sector, i.e. the commercial banks, starting to buy gold and use that as a monetary reserve rather than necessarily the central banks doing it. I mean, most of the Bank of England selling gold at $250 an ounce was one of the most foolhardy things anyone's ever seen.
Well, now we know why, because they were caught without the gold, and they had to manipulate the market, and Gordon Brown committed a heinous act of high treason, economically speaking, but I'm sure he does well on the speaking circuit. Now, in terms of the price, last few years, through the Gold Antitrust Action Committee, GATA, they've been very vocal in leading the parade in looking at these prices for manipulation for gold and silver. There's currently investigations here in the UK. HSBC is involved. And there's the LIBOR scandal, which, of course, shows that on a day-to-day basis, all the major banks, including the Bank of England, are involved in cooking the books, manipulating the market. Your thoughts on the gold and silver manipulation, what's going on there, number one? And number two, my follow-up question is, does it matter from your perch as a technical analyst? In other words, manipulation of prices versus the technical analysis. Does it matter? Does it sully your work as a technical analyst?
Not at all, because we've always worked on the theory that the market is bigger than any one particular player, and history has shown over and over in any market you want to look at. I mean, the market that the central banks have most tried to rig in recent times is the foreign exchange market. I mean, witness all the futile attempts by the Bank of England to support sterling at any one particular level, and the market has always won. And they had a huge vested interest in huge political will and huge, every whole establishment was over periods of time since the Second World War has tried everything to support levels of sterling.
Certainly Black Wednesday in '93.
And it's never worked because the market has always won. So if it didn't work in foreign exchange, where there was an enormous will to keep sterling at a particular level, I don't see any reason why it should work in gold. And witness the fact that GATA has alleged that there was this sort of semi-official, official attempt to keep the price of gold down. If there is, it hasn't worked very well because gold's gone up every year virtually for the last 12 years. So if there was an attempt to suppress the price of gold, it hasn't worked very well.
Well, some would argue that the prices has been creeping up despite the massive manipulation going on, but it seems as though the ability to keep that manipulation going is weakening, and these rallies would come as the result of the banks losing their ability to put on those naked short sales and those other silver manipulation schemes that we see out of the bank
But why? It's never been explained to me fully. Where is the interest in central and commercial banks trying to suppress the price of gold and silver, and, as Gatto alleged, gold mining shares and silver mining shares? I can't believe for a minute that the central bank gives one fig what the price of a silver mine share is doing. Unlike foreign exchange, which we talked about, where they have a massive vested interest, and they failed in that. So,
well, there's 2 points. Number one, you're saying that ultimately the market prevails.
Yes.
But clearly there's tension between paper money and gold and silver.
Absolutely.
And if you're engaged in quantitative easing and you're committing, as the Bank of England has done, to hundreds of billions of dollars of pounds to keep interest rates low and to drive money into paper, then the corollary, the natural corollary of this is to keep money out of gold and silver. As you pointed out, less than 1% or less of the global investing funds are in precious metals, despite a 10-year bull market. Despite a 10-year bull market in these metals, less than 1% of the investable assets are in precious metals, because, in large part, it's known on the street and in the city that these prices are being managed by these banks. Now, if they lose that ability and that investment percentage goes up by 1% or 2%, a couple of things happen. A, precious metals jump out of the box and go into a huge rally. You're saying 500% jump in silver in 3 years. That's the result of having been suppressed for a number of years. I mean, it's a beach ball that's being held underwater that they're letting go, and boom, that's a huge move. Gold, where's your target on gold? Do you have a target on gold? You got me rallied up now.
All right, okay. Well, we think gold's going to go to $2,500 an ounce from the current $1,700 an ounce, which is roughly 50% increase. But that's small beer compared to what we think silver's going to do. I mean, between June and September this year, silver went up 50%. I mean, it went up from $26 to $33, and it never got mentioned anywhere. When silver gets going, silver has huge moves, far bigger percentage moves than occur in gold. We also think silver, the ratio you referred to earlier on, we think that is understood. We think silver is quite cheap relative to gold as well.
Okay, let me finally ask you a question to follow up on this. James Turk was in a couple of days ago, and he was saying, making the point that gold has had a pretty clear phase one of a bull market. It's in a phase two. Silver is still in that phase one. Yes. It hasn't broken out. And what I'm hearing you say today, it reiterates this point. Yes. So can one say that buying silver today in the low 30s, it's almost like going backwards in time and buying gold at $900 an ounce?
Yes, I think so. I mean, I think that wouldn't necessarily be the way we would look at it, but the conclusion is the same. I mean, what he's saying is effectively what I'm saying is that the upside in silver is considerably greater than the upside in gold, given the same level of money printing that the central banks are involved in. Okay, Ian Williams, thanks so much for being on the Keiser Report. Thank you. And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Ian Williams of Charteris Treasury Portfolio Managers. If you'd like to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.